Chapter 5. Introduction to Credit. Credit. An arrangement that allows a borrower to get something valuable and pay the lender in the future. Credit card. A small plastic card that allows a borrower to buy goods and services on credit. Loan. The money borrowed from someone with a promise that the money will be paid back in the future. Mortgage. A type of loan used to buy a house. A. What is credit? Have you seen your mum buy groceries without using money? She swipes a plastic card in front of the register, signs a piece of paper, then takes off with grocery items. Did she just get the groceries for free? Not at all. She bought the groceries on something called credit. Credit is an agreement between a borrower, in the above example, mum, and a lender, the bank, in which the borrower gets something valuable and promises to pay for it in the future. Credit allows the borrower to get money, goods or services and immediately enjoy its benefits while delaying the payments for it. All money, goods and services gotten through credit arrangements have to be paid fully at some point in the future. Usually the total amount of payment made is more than the original price you paid, because when a borrower uses credit, the lender charges you interest for using the borrowed money. There are many ways lenders provide credit services to their clients. The credit may be in the form of credit cards, auto loans, student loans and home loans. Home loans are also known as mortgages. You may not notice it, but utility companies, gas, electricity, cable, water, also provide credit services. In your home, you are using credit every time you turn on the lights, flush the toilets, watch shows on cable TV, surf the internet, and use your cell phone. The utility companies give credit to your parents, and they allow your family to use their services immediately. Your parents will pay for the amount they use at a later time. B. The great things about credit. Cash. Money in the form of bills and coins. Debt. The amount of money a person or business owes. Statement. A report that shows how you used credit for the past month. There are many good things about using credit. When people don't have enough cash, they can still get things they need and want by using credit, then pay off the money they owe when money becomes available. Credit also allows people to borrow money against their expected future income. This is very helpful when purchasing pricey items such as a house, a car, or a college education. With credit, families are able to buy a house. People can buy cars to get to work. Credit allows students to go to colleges and universities as they go after their dreams. Credit makes buying more convenient and safer. With credit cards, you do not have to bring a huge amount of cash with you, especially when traveling. Credit allows you to buy goods and services online or through your smartphone. The statements you receive from the lenders also provide you with a good record of what you spent, what you've paid for, and what you owe. Businesses and governments use credit to grow and expand. With credit, businesses can get money to buy supplies and materials needed, even though they may be short on cash. They use credit for huge purchases such as buying factories, equipment, and vehicles. Businesses pay off their loans as they make profit. Tax. The money you contribute to the government to help pay for government projects and public services. The government also uses credit to pay for big projects like new roads, bridges, walkways and buildings. The government repays their debts with money they collect through taxes. A tax is the money you contribute to the government to help pay for those big government projects and public services, such as the police and the armed forces, schools, libraries, hospitals, parks and postal service. C. The not so great things about credit. Even though credit benefits a lot of people, credit can also be harmful. Remember that everything you buy with credit has to be repaid with interest at some time in the future. That time in the future is specific, not just any time you want to pay it back. There are deadlines. Not using credit correctly can cause a situation in which debts get too big and out of control. Overspending. Using more money than you should. Bankruptcy. A situation in which a person or business is legally declared as not able to pay back debts. Forgiving. Cancelling all or some of the debt. Credit report. A summary of the person's credit history, usually used to evaluate a person's credit standing. Because you have to pay interest for using the money you borrowed, what you owe, or your debts, could pile up faster than you can repay them. Overspending can put borrowers in a position where they can hardly keep up with payments. When they don't pay what they owe on time, it can result in a loss of valuable property such as the house and the car. So if you use your credit card and you don't pay back the money on time and in full, then you can get in big financial trouble. Failing to pay loans can destroy the borrower's good reputation. There are many times when spending too much and managing credit cards poorly causes a breakdown in family relationships. In some countries, failure to pay back loans is punishable by jail time. In many countries, a person with unmanageable debt might be forced to declare bankruptcy. Bankruptcy is when a person or a business is no longer able to repay the debt he or she owes. Bankruptcy offers an individual or a business a chance to start fresh by forgiving the debts that can't be repaid. In the United States, bankruptcy can only be granted by a judge in a state or federal court. You have to go to court to get approval to declare bankruptcy. Although bankruptcy does wipe away most debts, declaring a bankruptcy has long-lasting bad effects. Since bankruptcy will be reported in your credit report, it could keep you from getting new loans, or it may increase the interest rates that you will need to pay to get a loan in the future. Filing a bankruptcy involves a complicated and expensive process which will take time away from school, work and family. Also, bankruptcy can interfere with getting a new or different job. Employers can investigate credit reports before making job offers. A bankruptcy on your credit report may push the employers to offer the job opportunities to other possible employees who have shown greater responsibility with managing their personal finances. Chapter 6. Dealing with credit. A. Different types of credit. Let's look at the different types of credit that students like you will probably encounter in the near future. 1. Credit cards. A credit card is a small plastic card issued by banks and other businesses to its clients. A credit card allows the cardholder, or otherwise the person allowed by the bank to use the credit card, usually the person whose name is on the card, to buy goods and services on credit. The banks work with credit card companies like Visa, MasterCard and American Express to process the purchases made with credit cards. The cardholder can use the card worldwide because it is accepted in millions of places around the world. Store credit card. A credit card given by big stores can only be used for purchases in that store. Discount. Selling of goods or services at a lower price. Rebate. Returning a part of the payment you made. Big stores like Target, Sears, Home Depot and Macy's provide store credit cards. Store credit cards work like a regular credit card. The main difference is that most store credit cards can only be used to buy goods and services at the stores of the provider. Because of this restriction, getting a store credit card is easier than getting a regular credit card that you can use anywhere. Those stores also give discounts, rebates, and other rewards designed to benefit shoppers who come back again and again. The banks charge interest for the use of the credit card when the purchases made are not paid in full every month. So every month you will get a statement in the mail or online from the credit card company telling you how much you owe and when you have to pay it back by. If you don't pay the full amount during the grace period, which may be 15 to 30 days from the date that you get the statement, the credit card issuer or bank will charge you a very high interest rate, ranging from 10% to 24% per year. That means that almost a quarter of the amount you spent could be added on in interest. So a $100 purchase could become $124 that you owe if you don't pay back in full. If the cardholder does not make the minimum payment on time, the interest rate can even go much higher. On top of the interest, the banks can also charge a separate late fee if you are late in paying back, making what you bought a lot more expensive than the original price because of all the added fees. Cash advance. Borrowing money in the form of cash from a credit card company. Bank teller. A bank employee who helps customers with their banking needs. Check. A piece of paper that tells the bank to pay the stated amount to another person or business. Credit card holders can also take out cash using their credit cards. This is called a cash advance. A cash advance is like asking the credit card company to give you money that you can spend on anything you want. You can get cash through an automated teller machine, ATM, a bank teller inside the bank, or by asking the credit card company to send you a check. Card holders can get cash up to a certain limit, but it is not a good idea to take cash advances using a credit card because the fees and interests associated with this are very high. Cash advances should only be used during emergencies and must be paid off immediately or as soon as money becomes available. 2. Student loans. Going to college is one of the best decisions you can make for yourself. Studies show that people with college degrees earn much more during their lifetime than those without college degrees. But a college education can be expensive, especially if you go to one of the very famous private colleges and universities. Student loan. Money borrowed to pay for educational expenses. Repayment. Paying back the money you owed. To pay for a college education, students usually apply for student loans. This loan can be used to pay for school tuition, books, computers, and living expenses. The good news with student loans is that repayment, or paying it back, does not start until the student is done with school. This allows the student to focus on studying and not to worry about the payments while he or she is still at school. The bad news is that the loan cannot be cancelled or erased even if you did not like the education you received, you did not get a job related to your degree, you are having a hard time financially, or you declared bankruptcy. Therefore, any student who wishes to apply for a student loan must seriously think about the total amount he or she will borrow, as well as how he or she plans to repay the loan over the years. You certainly do not want to be drowning in a flood of debt when you are done with college. 3. Car loans. Down payment. The first bigger payment required when buying more expensive goods and services on credit. Balance. The amount of money still owed. Installment. Multiple equal payments made by the borrower until the loan is paid in full. Car title. A paper that identifies the legal owner of the vehicle. Grown-ups can use car loans to purchase new or used cars. Auto loans are provided by banks, car manufacturers, i.e. the ones who make the cars, and sometimes by the car dealers. Dealers are the ones who sell the car. This is a one-time loan, which means the lender will release the money one time to complete the sale of the car. Oftentimes, the car buyer will be required to pay a portion of the sales price called a down payment, up front and right away. The balance will be repaid by the car buyer in equal monthly payments called installments. Car loans can have a term of up to 7 years, meaning you can take up to 7 years to pay off the loan and the interest. Although the borrower gets to take the car title remains with the lender until the borrower has fully paid the loan. The car title is a legal form that identifies and certifies the legal owner of the vehicle. Once the borrower has paid off the car loan, the title will be transferred to the borrower's name. B. Getting credit. Not everyone who applies for a credit card or a loan can be approved. The banks give credit to qualified people applying who can and who will pay back the loan. But how can a bank know that the person applying for a loan is a good borrower and will pay back what he promises to? Banks have several ways of figuring out if they are going to give credit or not. To give a credit card or a loan, you have to fill out an application form that asks you a lot of questions about your financial life. Although banks look at several things when figuring out the creditworthiness of the borrower, most banks care most about the borrower's character and capacity. Let's look at each of these. 1. Character. Character. The reputation and the traits of the borrower in handling money and debts. Credit history. A record of how responsible the borrower is with paying his or her debts on time. Credit score. The numerical grade or rating you received based on the information in the credit report. Character refers to the reputation of the borrower. Character shows the willingness of the borrower to repay the loan. Banks figure out the borrower's character by reviewing the borrower's credit history, credit score, educational background, and work experience. When a person applies for credit, the lender or the bank will get the applicant's credit report. The credit report tells about the person's credit history, including his or her track record of paying back debts on time and the amount of debt that is still owed or still has not been paid back in full. The credit report also provides the person's credit score. The credit score rates how the borrower has managed past loans and the amount of loans they still have to pay off. A borrower with more than 1 or 2 late payments will have a lower score. Having too many loans to pay, such as too many credit cards with money owed on them, can also pull down a credit score. The credit score plays a big part in the bank's decision on whether to loan the money or give the credit card, as well as the interest rate that will be offered to the borrower. People with high credit scores will most likely get an approval on their loan application. They will also receive good interest rates. On the other hand, the banks may decline the loan applications of a borrower with a very low credit score. If you have a low credit score and the credit card company or bank still decides to loan you the money or give you a credit card, then you will probably get charged a higher interest rate. Taking care of your credit reputation is a very important responsibility. If you do not pay your debts on time, this will haunt you in the future when you apply for loans. Having a bad credit reputation costs a lot because lenders will charge you higher interest rates. The higher the interest rates you pay for your loans, the more money goes out of your pocket. 2. Capacity. Capacity. The ability to pay back the loan. Co-signer. A person with a good credit standing who signs the loan document with the main borrower, also becoming responsible to pay back the loan if the main borrower stops making payments. Capacity refers to the borrower's ability to repay the loan. When a person applies for a loan, the banks will look at the borrower's income, how stable his or her job is, how many other loans the borrower owes money on, and how much he or she has paid back. Having a stable job, one that has lasted or should last, and good income shows that the borrower can make regular payments when the loan repayments are due. If the borrower's credit or employment does not look strong enough, the bank may ask for another person with a good credit history and good income to co-sign on a loan. A co-signer is someone who will sign the loan document together with the main borrower. The co-signer will become responsible for the loan if the main borrower stops making payments. Co-signing a loan usually happens when a student is applying for a student loan. Since the student has no credit history or stable sources of income, the lender may ask the parents to co-sign the loan application. If the student fails to make the regular monthly repayments after college is over, the lender will try to collect the money from the parents or whoever co-signed the loan. When getting a loan and having a co-signer, remember that you need to be extra responsible in paying off what you owe and when you owe it. Any missed payment will not only damage your reputation, but will also harm the reputation of the person who generously co-signed with you. Chapter 7. Save your money. A. Why bother to save? At the start of this class, you heard me say that saving money is very important. With how easy it is to get credit cards and the convenience of buying almost everything online, shopping just got a lot easier and more tempting than ever before. There are many reasons why you need to save though, but there are 2 reasons to help you realize the importance of saving. 1. To prepare for the big purchases. At a young age, it is okay to wish for the latest smartphone, a new tablet, a bike, an electric scooter or an iWatch as a holiday or a birthday present. You should always be thankful for all the gifts you get, even for those that are not included in your wish list. If you did not receive an item from your wish list that you really want, why not help your parents buy it for you by contributing some money toward the cost of the item? You can do so by saving some money from your allowance or from the cash gifts you receive during your birthday or holidays. Your parents will surely appreciate this wonderful gesture. The more money you can contribute toward the cost, the higher the chances are that your parents can buy it for you. When you grow up, there are really expensive things you may want to buy. You might need a car to drive you to work or a house for your own family. One day, you might decide to go after a higher university degree or extra training to boost your career, or maybe you go back to school so you can switch careers. You might want to have a memorable and colourful wedding, or you might want to travel and explore faraway destinations with your loved ones. You can do all of these things especially when you have savings to back you up. Risk. The chance or the possibility of losing money. When buying expensive items like a car or a house, most people apply for a loan. Having money set aside for a down payment can help you get a loan with reasonable interest rates. Banks like it when you have bigger down payments because it lowers their risk of you failing to pay back the loan. Likewise, when you provide a big down payment, it lowers the amount of money you need to borrow and makes your monthly installments more affordable. 2. To prepare for emergencies and unexpected expenses. As the saying goes, life is full of surprises. You surely like happy surprises, but sometimes unpleasant surprises can also come when you least expect them. Your car could break down and might require huge repairs. A pet dog might get sick and need to see a veterinarian. A water pipe could burst, causing a flood inside the house. You might have to fly to attend a funeral of a loved one. You might even just lose your job. Emergencies and unexpected expenses can put a lot of pressure on your wallet. But if you have money set aside for events like these, you will be in a much better position to handle the challenges brought about by these unwanted surprises. That's why saving money is so very important. B. A budget. A great tool to help you save. Budget. A plan of how much you will spend and save for a period of time. Living within your means. Spending no more than what you have or what you can afford. There are so many things you can buy at the local store or even online. With all the choices you have, it can be difficult to decide how you will spend your money and how you will still save a portion of it for the future. For that reason, having a budget will be helpful in managing your money. A budget is a plan of how much you will spend and how much you will save for a period of time. Making a budget is important because a budget allows you to figure out the amount of money you can spend, where you will spend it, and the amount of money you can set aside for savings. Following a budget keeps you out of debt because it enables you to live within your means. In other words, a good budget helps avoid overspending. When making a budget, you need to list all the sources of your income on one side and add them up. Your income includes the allowances you get from your parents, the money you receive from having a job, and the money you receive as presents. On the other side, you need to list all your expenses for that period of time and add them up. Subtract the total expenses from the total income. Should you choose to donate money, you will need to subtract this amount from your income as well. If the difference is a positive number, this means you are saving. Otherwise, if the final number is negative, this means you are overspending. As an example, let's look at how Ben uses a budget to manage his money. Ben's budget for the week. Income. Weekly allowance, $25. Lucky chap. Gift from grandma. Another $5, bringing the total income to $30. Ben's expenses. Food, $15. Drinks, $5. He's bought a book for $3 and he's bought a pencil for $1. That brings his total expenses to $24. And on top of that, he made a $1 donation to the church. So the total expenses is $25. So, if Ben has a total income of $30, his expenditures are $25 per week, how much is Ben able to save each week? So that's $30 minus $25. Who can do that in their head? That's it, $5. Ben is managing to save $5 a week, which is great. You can see from Ben's budget that he is not overspending. He figures out where he will use his money, and in the process he saves a whole $5. Ben is doing a wonderful job making a good budget and managing his money. Why don't you give it a try and see how much you can save each week? C. Banking tools to help you save. Insured, guaranteed against losing money. Deposit account, an arrangement with a bank that allows a person or an organization to put in and take out money. Withdraw, to take out money from the bank. The bank is probably the best place to safely store your money. Banks have fireproof steel vaults that can only be opened by certain individuals under very tight security. In the United States, the money deposited in banks is insured by a government agency called the FDIC, which stands for Federal Deposit Insurance Corporation. This means that even if the bank ran out of money, got robbed, or even burned down, you can still get back your money up to $250,000 per bank through the FDIC. Banks offer several ways to keep your money safe and to make it more convenient for you to handle your finances. Let's look at them. 1. Savings account. A savings account is a deposit account used by individuals and businesses mostly to save and protect their money. The money deposited in a savings account earns a small amount of interest. The money can also be withdrawn any time the bank is open. Almost anyone can apply for a savings account. Some parents open savings accounts for their children when they are very young to encourage them to save. A savings account helps you to be smart about your money because the money saved in a bank is harder to get compared with money stored in a savings jar. And remember, your money grows while in a savings account because of the interest you earn for letting the bank hold and use your money to lend to other people or to other businesses. 2. Checking account. Have you ever seen your parents write a check to pay water and electricity bills? Did you receive a check as a birthday present? What did you do with that check? Like a savings account, you also deposit money into a checking account. Unfortunately, most checking accounts do not pay interest. What makes the checking account special is that it allows you to use that piece of paper called a check to buy goods, pay for services, or give money to another person or an organization. Payee. The person or business a check is made out to. Bounced check. A check that is not accepted because there's not enough money in that account. When your mum writes a check, she is in a way ordering her bank to pay a specific amount to the payee, who is the person or the business to whom the check is made out to. Your mum needs to have enough money in her checking account to make the payment successful. Your mum cannot write an amount greater than what she has in her checking account, or else the check will bounce. If your mum's check bounces, the bank will charge her a fee. A fee will also be charged to the payee by the bank where the bad check was deposited. People use checks because it is easier and safer to carry a checkbook than a bunch of cash in your pocket. Cash can be easily stolen, whereas a check is only good if it is signed by the owner of the checking account. When making payments by mail, checks are safer because only the payee can deposit the check in a bank or exchange the check for cash. Checks also give you a permanent record of a payment. That way you can better keep track of payments you make with your checks. 3. Debit cards and ATMs. Debit card. A card that lets you take money directly out of your checking account to make a purchase. Debit cards and ATM cards are two good ways to get money out of your savings or checking accounts. Debit cards look like credit cards, but they are not credit cards. You can use a debit card to purchase goods in a store, just like when you are using a credit card. But the debit card is electronically tied into your checking account. So every time you use the debit card, the money is automatically taken from the checking account right away. A debit card will only work as long as you have money in your checking account. Unlike credit cards, a debit card does not allow you to borrow money from the bank. When you were younger, you might have thought that ATMs were money machines that magically gave you money. I know I did. Unfortunately, there is no such thing as a magic money machine. ATMs are electronically linked to your savings and checking accounts. Withdrawing money from an ATM is similar to going to a bank and taking out money from a bank employee called a bank teller, who stands at a window and helps you to do what you need to be doing inside the bank. With an ATM, the transactions are processed through a machine. You can deposit or withdraw money anytime or anywhere you can find an ATM. But be careful, some ATMs charge an extra fee to use them. It's always best to use your bank's ATM. Certificate of deposit. A deposit account that pays more interest than a savings account, but it has a fixed date when banks will pay you back. Maturity date. The date when money will be paid back. A certificate of deposit, also known as CD, is similar to a savings account, but the money in a CD earns more interest than money in a savings account. A certificate of deposit has a maturity date, which is the time when the bank will pay you back your money plus the interest you have earned. You can choose the maturity date you want when you open a CD account. It can be anywhere from 3 months all the way to 5 years or longer. The interest rates you earn usually get bigger the longer you leave the money in a CD. In Australia, we call CD accounts long-term deposit accounts. Banks provide higher interest rates on CDs in exchange for a guarantee that the depositors will keep the money in the bank until the maturity date. If you withdraw the money before the maturity date, the bank will charge you with an early withdrawal fee. This is why CDs are sometimes called time deposits. A smart way to manage your savings is to balance the money you deposit into your savings, checking and CD accounts. If you do not expect to make a big purchase in the next few months or years, it makes a lot of sense to put a big chunk of your savings into CDs so your money can earn more interest income for you. It is also a good idea to leave some money in your savings or checking accounts to be used for emergencies and unexpected expenses. Chapter 8. Money and our economy. You heard a newscaster mention the word economy in a report, or your parents talking about the economy over dinner. What is so important about the economy? Does it have anything to do with your money? Economy. The way a nation uses its limited resources to produce goods and services. Resources. The supplies used to produce goods and services, which may include materials, land, money, and people. The economy is the way a nation or a country uses its limited resources to produce goods and services. A healthy economy means the country is making good decisions and using its resources such as land, materials, workers, and money to create more products and services. You benefit when the economy is growing because more jobs are available and businesses are making money. The opposite is true when the economy is weak. People may be losing jobs and businesses may be closing down. Many people and businesses are hurt financially when the economy is weak. Let's take a closer look at some factors that can affect the economy and you. A. Demand and supply. Demand, the desire and willingness to buy goods or services. Supply, the availability of goods and services. Have you ever wondered why the prices of gasoline, food, and other goods keep changing? Although business owners can set the prices of the goods and services they offer, the two main factors affecting price are the demand and the supply. Shortage, a situation when there is not enough to satisfy a need. It happens when the demand is greater than the supply. Surplus, a situation when there are leftovers after meeting all the needs. It happens when the supply is greater than the demand. Demand is your wanting and willing to buy the goods or services, and supply is how available or easy it is to get the goods or services. Generally, when the demand is greater than the supply, a shortage occurs, which forces prices to go up. Prices go up when the demand is higher because people are willing to pay more for an item that they badly need or want, especially when there is a shortage of that item. Similarly, when there are more available items than we want, supply is greater than the demand, a surplus occurs, which forces prices to go back down. Prices can go down when there is a surplus because the sellers will likely lower the price to encourage buyer to make a purchase. When supply and demand are equal, then the prices will stay stable. Here are some examples of how changes in demand and supply can affect the price. During championship games for major sports like football, basketball, and baseball, more fans want to see the championship games live inside the stadium. The supply of game tickets to enter the stadium is fixed, since the stadium can only hold a certain number of people. The price of the game tickets go up. With the release of the iPhone 6, the demand for older versions, such as the iPhone 4 and the iPhone 5, goes down as more people choose to buy the latest version. The price of the older versions of iPhone goes down. A fire in a gas refinery causes a shutdown. The supply of the gasoline falls because there is not enough gasoline anymore to meet the demand. So the gas prices go up. Grapes are plentiful during the year because of good growing weather. There are more grapes than the people would actually buy and more than they can eat. So the price of grapes falls down. Having a good knowledge of demand and supply can help you make good choices when spending your money. If you know that the demand for an item is still very high, you might consider waiting for the demand to go down and buy the item at a later time when the price will be lower. Say you have a smartphone and find out that a newer version is coming up soon. Is it really worth buying the latest smartphone at its highest price when the demand is still very high? Can you wait a little bit to upgrade your phone, only when it is really necessary to make that switch? Or when you watch a movie, do you go to the big crowd that watches the movie at night when the movie tickets are more expensive than during the daytime shows? An understanding of the concept of demand and supply can actually help you save some money and make you a smarter shopper. B. Inflation. Did you know how much a gallon of milk cost in 1975? It was $1.57. In 1995, the price was $2.41. By September 2015, the cost of a gallon of milk was $3.39. Why does the price of milk keep going up and up and up over the years? Inflation. The general increase in prices of goods and services. Prices of goods and services go up because of inflation. There are several reasons inflation can happen, but the main reason is the increase in the demand without a similar increase in the supply. For example, when people have more money due to an increase in salary or more access to credit, they tend to spend more. Remember, when the demand is greater than the supply, prices will go up. Let's look at the estimated price of other items in 1975 and September 2015. Gallon of regular gasoline was 57 cents in 75. In 2015 it was $2.38. A dozen eggs was 77 cents. In 2015, $2.97. A first class stamp was 13 cents, is now 49 cents. Average sale price of a new home, $42,000. In 2015, it is $296,900. When inflation occurs, our money can buy less. For instance, when the price of a movie ticket increases by 10%, the movie ticket that cost $10 a year ago will now cost $11. Therefore, more money is needed to buy the same amount of goods and services. Imagine if there are 5 of you in a family. Your family will pay an extra $5 this year just to go to a movie. Because of inflation, it is not smart to keep all your savings in a piggy bank. Use your piggy bank only to save money until you can put it into your savings account. When you put your money in a place where it is not growing, like a piggy bank, chances are the money you have will have less value when you use it in the future. Inflation can also be difficult for people who are living on a fixed income, like older people who are retired. This is because they usually have less money than they did when they were working, and their buying power gets smaller during times of high inflation. Their $20 today would only buy a portion of the groceries they used to buy back in 1995. Although the rate of inflation changes every year, and it is normal to have inflation of 1 or 2% every year, there were times in the 1970s and the 1980s when inflation reached 12%. When prices are rising by 12% every year, the price of goods and services will double in 6 years. This means your money will be worth half in 6 years when the prices are rising by that much. C. Unemployment. Unemployment. The number of people who are looking for work but cannot find a job. The unemployment number is an important way of telling if the economy of our country is healthy. Every week, the government releases the unemployment number, which is the number of people who are able, willing, and looking for work but cannot find a job. When unemployment is high, only a few job opportunities are available for people looking for work. People with no jobs will have tougher times getting the goods and services they need, resulting in fewer sales and profits to businesses, which in turn results in more jobs being cut. This cycle continues until the economy turns around and gets better again. When making financial plans, you should always take into account the possibility of losing your job. People should have money set aside for emergency situations like this. People who are in a lot of debt are also pushed to the edge when an unexpected job loss happens. This reminds you of the importance of living within your means and not overusing credit cards even though you think you can afford to pay back the money using your future income. Because there is always the chance that there will be no future income.